Hello, podcast listeners. It's Tim and Julie Harris with Tim and Julie Harris Real Estate Coaching Radio. And today we have a very special guest. Peter Schiff is a well-known American investment broker, author, economic forecaster, and investment advisor. His strategy is strongly influenced by the free market Austrian School of Economics. He is credited with accurately predicting the 2007 housing market collapse and the subsequent 2008 financial crisis in the United States. His expertise in financial matters and economic theory has made him sought-after speaker and analyst at various forums. His views and predictions have been aired across the spectrum of media, including the Wall Street Journal, Washington Post, CNN, and even Al Jazeera. He also hosts his own radio and television shows and runs a video blog and podcast on financial matters. Schiff started his career as a stockbroker and went on to establish various financial establishments, including a brokerage firm and bank. His investment strategy focuses on long-term wealth savings with emphasis on emerging market and commodity-focused investments. He's a strong supporter of the Libertarian Party and contested for the Republican nomination to the 2010 United States Senate elections in Connecticut. So without further ado, here is Mr. Peter Schiff. It's our pleasure to welcome you as our guest.
Yes, and our neighbor. And
our neighbor.
And our friend. So thank you for being on our podcast. We sincerely appreciate it.
Oh, sure. Thank you for inviting me to be a guest on your podcast.
We've been trying to set this up, as you may be thinking about it, over the last 2 years to get you on the show. So finally, you said yes, so we appreciate it.
Persistence pays off. I guess being a neighbor, that doesn't hurt either. So
that's right. So we're going to talk about the reason that there's a whole bunch of reasons that we wanted Peter on our podcast. But from Julie and I, from a personal perspective, and I've told Peter this before, Peter was a significant influence on Julie and I's life back in 2005, 2006, and 2007, when we saw from the coaching perspectives, we saw in all these different markets, we saw signs of the market was definitely going to have some sort of interruption of some variety. No one predicted, except for maybe Peter and a handful of other people, how significant that would be. But because Julie and I listened to Peter Schiff and a couple other people back when everyone else was saying housing would never crash, because we did listen to him, we positioned ourselves personally and professionally to be ready for it, and then to prepare all of you guys for it who are coaching clients, teaching you guys how to do short sales and work with distressed real estate and all of that. So Peter was instrumental in our formidable years of learning how to pivot when the markets are shifting. So Peter, again, I'm going to publicly thank you for your influence on that.
Thank you. We owe you a debt of gratitude. And you saw it certainly before we did. Yeah. We were lucky enough to be paying attention, reading your books, listening to you, and took action, I think, at least significantly, before we probably would have. So thank you for that.
Right. And so you have to be cognizant, though, of what's coming ahead, because it's going to look a lot different than the 2008 financial crisis. So the dynamics are going to be different. And the implications for the markets are different in the way that you have to position yourself.
And that is the reason we wanted you on today's show. So we wrote a whole bunch of questions down, and you can drill down on any of these as long as you want, obviously. And where we're hoping to go is tactical, practical information, so these guys can prepare themselves for the changes that are inevitable, but also then prepare their own clients, real estate clients. And maybe we have probably 10% of all of our listeners who are not in real estate, they're business owners. So let's start out with a real basic question. What is inflation?
Well, inflation is an expansion of the money supply. That is what the word means. If you think about the word inflate as a word, well, what is inflate? Well, inflate means to expand, right? If you inflate a balloon, the balloon expands. So what is expanding when you talk about inflation? It's the money supply. The government creates new money, puts more money into circulation. That expansion is known as inflation. Deflation is the opposite. You contract the money supply, and money supply deflates, just like a balloon. You fill it with air, it expands, it's inflated. You deflate the balloon, the air comes out, it contracts. So that's what happens to money supply. It expands and contracts. Now, there are many effects of an expansion of the money supply. One is that prices rise, or sometimes prices may fall, but they'll just fall by less than they would have otherwise fallen had there been no inflation. But people confuse the result of inflation with inflation itself. And if they don't see a rise in consumer prices, they just assume there's no inflation. But there could be a lot of inflation. maybe without all that inflation, consumers would have benefited from falling prices. But instead of benefiting from falling prices and a lower cost of living, they're suffering higher prices, and the difference is inflation.
Okay, that makes sense. So there's a lot of, Julie and I listened to your podcast, the Peter Schiff show. You guys should listen to it as well. So you've been talking a lot about inflation. You've been talking about inflation really, I mean, since we started listening to you years ago, but a lot in the last 2 years. And so the normal rate of inflation is the next question, but I know the normal rate all depends on what the government is doing to, what consumer prices and whatnot it's tracking to really come up with the normal inflation rate. But what is historically the normal rate of inflation, and what are you seeing that's happening now?
Well, there is no normal rate. I mean, ideally, if you're talking about prices, consumer prices, because most people, when they talk about inflation, talk about, consumer prices. The normal thing in a free market economy for consumer prices is to go down. That's what's normal. And in fact, if you look at the US economy in the 18th century, right, from 1800, or rather the 19th century, the 1800s, from 1801 to 1900, prices fell for 100 years. I mean, the general price level in 1900 was half of what it was in 1800. So prices were cut in half over 100 years. And during that 100-year period of falling prices, Americans prospered. I mean, if you look at the second half of the 19th century, the Industrial Revolution, that economic growth that we enjoyed as Americans during that period far exceeds anything that's taken place since, either in the 20th or now the 21st century. So we had massive economic growth, yet prices were going down pretty much every year. So we don't get that anymore. We get rising prices. I don't know what the normal rate, the historic average rate is certainly lower in the last decade than it has been. But a lot of that is based on the way the government measures prices. Because over time, the CPI, right, or some of the other official government yardsticks have been dramatically altered so that no matter how much prices go up, the CPI doesn't really reflect that. And I think that is by design. I mean, the government creates inflation deliberately for its own purposes, its own benefit, but then it wants to cover up the effects of inflation so the public doesn't complain and the Fed can continue to justify its monetary policy. But, if we still measured prices using the exact CPI that we used to measure them in the 70s, I think the annual gains would already be well into the double digits. In fact, for 2021, the first digit may be a 2, not even a 1. That's how bad it already is. And it's going to be even worse in 2022.
So paint us a picture about that, Peter. What do you believe is the real, if you can, because I've heard you talk and you just mentioned that how they report it isn't exactly covering everything. It's mixed statistics. What do you think the real rate of inflation is now? And paint us a picture for a year out. Where are we headed?
Well, it's high. I think it's double digits. It's north of 10% and headed higher. And there's no relief in sight. If anything, it's going to get worse because from the government's perspective, allowing inflation to get worse is better than fighting it. Because if they fight it, they're going to immediately set off a chain of events that is politically a non-starter, right? If the federal government or the Fed were to fight inflation, we would have not only another real estate crash, stock market crash, bond market crash, we'd be in a depression, and the US government would have to slash spending. I mean, we wouldn't be talking about how much new stimulus we're going to get. It would be how much of the old stimulus are we going to lose, right? The government would have to contract. See, there's a big difference. If you look at where we were in the housing bubble that kind of popped, in 07, right? The Federal Reserve under Greenspan lowered interest rates to 1%. That was a mistake. And then it took the Fed a long time to get back up to around 5%. That was also a mistake. And during that period of time, we inflated this housing bubble, but at least the Fed tried to normalize interest rates. And it was the increase in interest rates that pricked that housing bubble because it increased the cost of financing a home. And then by increasing the finance costs, it made homes more expensive. More people could no longer afford to pay those prices. Prices started to fall. When prices started to fall, people started mailing in their keys because they couldn't make their payments. A lot of people had adjustable rate mortgages that reset with the higher rates, and it was a collapse. But this time, the Fed lowered interest rates to 0, which was an even bigger mistake than 1, and has left them there pretty much for the last 12 years. I mean, there was maybe 1 year, 1.5 years where, we got above 0, we got up to about 2%, and then we went right back down to 0. But the Fed never normalized interest rates, nor do I think they have any intention of even lifting interest rates above 0. So rather than pricking the real estate bubble, what they're going to do is end up pricking the dollar bubble, which is an even bigger bubble. We're going to have massive inflation. And then instead of real estate prices crashing, they end up going up even more because the dollar crashes instead. And as the dollar loses value, you need more and more dollars to buy anything, right? That would include real estate. But where I think you're going to see the decline in real estate values, as well as stock values and all sorts of other assets, is if you measure them in the price of gold. Because I think
we're going to get to that towards the end. And I also want to talk to you about hyperinflation too, because that's something we're seeing more and more people talk about. The next question we wrote down. So in real estate, they say the average rate of appreciation for a house every year has historically been about 3%. Appreciation, inflation, call it what you will. So can you explain to them what the difference is between appreciation and inflation in economic terms?
Well, in appreciation, you would think of the real value of an asset over time. If it's appreciating, it is gaining a value. But if its price is only rising as a reflection of inflation, really a loss of value of the money that you're using to measure prices, then it's not a real appreciation. It's like if I measure myself with a ruler, 12-inch ruler, and I'm 6 feet tall, and then I knock an inch off the ruler, so now the ruler only has 11 inches, and now I'm, 6.5 feet tall. I didn't grow just because I'm measuring my height with a smaller ruler. So if the dollar loses value, and now you price your assets in dollars that have diminished value, that doesn't mean that the asset is actually appreciated. It just means the currency that you're measuring it in has depreciated. And I think that's really what's going on with residential real estate. It's reacting to inflation because there's no reason for real estate to appreciate unless you improve it, right? You actually physically have to do something to the house, make it better. Because if you just live in a house, it's going to depreciate over time because you're using it. It wears out like anything else. And unless you spend a lot of money maintaining the house, it's going to lose value even faster. I mean, think about all the houses, in our neighborhood that are tear downs. I mean, what is a tear down? A house that used to have a lot of value and now it's worthless because it's out of date, and people want to get rid of it and build something new. What could make real estate appreciate is if the location, for example, becomes a lot more desirable, again, like what we're experiencing here, where you have a lot more demand for real estate in one area, but that would come at the expense of a loss of demand for real estate someplace else. Because if a lot of people want to move into a particular location because now that location is more desirable, well, they're moving from someplace else. So that other location is becoming less desirable. So in aggregate, you're not seeing any real increase in value. You're just seeing some markets going up as other markets are going down. But to see the entire real estate market going up by 2% or 3% a year, that's really a reflection of money losing value and therefore real estate being more expensive to buy, even though it's depreciating because you're using it, right? But then if you improve it, if you buy a house and you add a bedroom or you redo the kitchen and you make it nicer, that can make it more valuable because you added value, you spent money. But once you've made those improvements, as you use them, the house gradually deteriorates again because you're using it. Just like you buy a car, nobody buys a car and expects it to be more valuable after they've driven it for a few years. It loses value. Houses also lose value. They just lose value more slowly than cars.
Except in this time when used cars are selling at their 25-year peak. It's crazy, right? Parallel universe.
Well, that's inflation. That's really what's going on, where used car prices, and I think used car prices are going to keep rising, but again, it's because the money is falling. Everything is getting more expensive. It's not just cars. Just whatever you want to buy. Look at food prices, look at toiletries, look at what it costs to buy toothpaste, deodorant, shampoo, everything. I forget, they always try to calculate how much it costs to make a Thanksgiving dinner. Well, it's going to be not only a new record this Thanksgiving for how expensive, the turkey is and all the fixings, but it could be the largest annual increase we've experienced.
Didn't they did that last year, and didn't they have, there was like hidden inflation, right? They were saying a can of this and a can of that, but what they didn't take into account for it was actually less quantity. So they didn't
probably
say, it was not a 20-pound turkey, it was like a 5-pound turkey, but it was still a turkey. So this actually leads to the next question. Julie and I, I'm 51 and Julie's 35. She's been 35 for the last 15 years.
I'm repeating the year.
She's been, 35 for 15 years. But so the last time there was any inflation, we were kids, and a vast majority of the people listening to this podcast, they've never really experienced inflation before. And so we can intellectualize that, but actually to live with inflation where consumer prices are increasing and gas prices are increasing, people are just starting to experience that. And it feels almost like an anomaly, not like the new normal. So what way, go ahead.
Yeah, well, I was gonna say we've had inflation. We just haven't acknowledged it. We've kind of been, covering it up. And one of the ways we've been able to offset the benefits, offset the cost of inflation, is through outsourcing. So when you and I first started to grow up, almost everything that we bought was made here in America. But now almost everything we buy is made someplace else. And that's because as the cost of producing things went up in America, we kept relying on foreigners. And so now, we pay for the inflation in different ways. Like back in the 1970s, if I needed to buy something, I went to the store and I bought it, and it was fully assembled when I brought it home. Now I want to buy something, it was made in China, it comes on a truck from Amazon, and it takes me 2 or 3 hours to put it together, right? Because I've got instructions that you can barely read. I always end up with extra pieces. But how much is my time worth, right? We don't measure the fact that something that used to be assembled now requires hours of my time to put together. There are a lot of things. We've automated. So, you have to deal with computers. You don't have live people that answer the phones. And so a lot of stuff takes longer because the computer, doesn't really understand what you're saying. And you get trapped in this, voicemail hell. Whereas before everybody had real people answer the phones right away. So we found ways to get around rising prices, but in ways that have really diminished our standard of living. I think a lot of products have suffered in quality. The type of material that is used has declined, or the ingredients. We don't have all the fresh foods that we used to have. Now you want to buy something that's organic. You don't want all these, pesticides, whatever. It costs a lot of money, but 20, 30 years ago, everything was organic. That's how everything got farmed. But we had to find more ways of producing stuff. And so we don't capture it. I did an experiment. This was in 2013 to show you just how bad the CPI is. So I looked at the CPI, and I did a YouTube video about this back in 2013. But the government had claimed that newspaper and magazine prices over the 10-year period that ended in 2013, that the prices were up 30% during that 10-year period. And so I decided to check, because it's not hard to check. You just look at the magazines, see the price, and then go on the internet and look at the prices, covers, the photographs from 2003. And I took the top 20 circulating newspapers and magazines in the country. And when I actually compared the price written on the cover in 2013 with the price written on the covers in 2003, the actual rate of increase was about 130%, not 30%. So there was a 100% increase that somehow got missed by the CPI. Now, how? I have no idea. Like, you put the price in and then the price comes out at the other end and it's not nearly as big an increase as what was actually there. So I don't know the mechanics, how the CPI did that. I just know that it did it. And I think it was deliberately designed to really hide the true degree to which prices are rising. And again, that's by design. The government doesn't want us to know. But what's different now is that the inflation that we're experiencing now, as far as consumer prices, is so much greater than what we were experiencing in the past, that it's far more noticeable and it's a much bigger problem. And that problem is going to get a lot worse.
Well, so who benefits from inflation?
Well, when you understand what inflation is, it's pretty clear who benefits. So first of all, inflation transfers wealth from creditors to debtors. Because if you borrow money and then there's a lot of inflation, when you pay back the money you borrowed, it is less valuable than the money that you borrowed. So if you could borrow money, for example, and use it to buy a piece of real estate, and then there's a lot of inflation and the value of that money goes down, when you pay off the mortgage, the lender is not getting returned to him money that has the same purchasing power as it was when he loaned it to you. So that lender loses and the borrower wins at the lender's expense because he gets the benefit of using the loan to buy a real asset that holds its value and then repays the loan in money that has lost its value. And so let's say there's hyperinflation or very, very high inflation. If I borrow, say $500,000 to buy a house, and then there's hyperinflation, and you need $500,000 to buy a pack of chewing gum. What is the lender getting back for the money that he loaned me? He loaned me enough money to buy a house, and all I'm doing is giving him back enough money to buy a pack of gum, right? So it's the lender that loses. And if you look at who is the biggest, debtor in the world, it's the US government. The US government has a national debt of almost $30 trillion. And so if there's 10% inflation, that knocks $3 trillion off the debt, right? So the government wins. Who loses? The bondholders, the people that bought US treasuries or anybody that holds US dollars, they suffer that loss that the government gains. But the government also has all sorts of ways that it benefits from inflation. Inflation creates phony gains that they tax, right? People have appreciation in their assets. The government taxes it, but it's not real appreciation, it's dollar depreciation. Also, Social Security is indexed to inflation. And to the extent that they lie about inflation and then they don't have to increase Social Security as much, that's a way to reduce Social Security benefits without voting to cut them. And that's what they want to do. They want to cut benefits without having to be on record as voting for the cut. So inflation benefits the government in all sorts of ways. And of course, when the Federal Reserve monetizes the debt, creates inflation by printing money, they're buying US treasuries. They're monetizing the debt. They're making it easier for the government to finance its debts. And by artificially limiting interest rates, because that's what inflation does, the Fed is printing money and buying bonds to keep interest rates down. That enables the government to continue to service its debt. Because if interest rates were allowed to go up, the government would have to default.
Sounds like a big chess game.
The next question, actually, Julie, this is a good one for you.
About the top.
Yeah, this one.
Yeah.
Right there.
So can inflation lead to deflation, or are prices / values resetting to, you just did that, to what they used to be, I think is what it said.
Yeah.
What happens does it stop? Do the prices keep there and then they level out and they stay high? Because we hear all the time, they're saying, well, it's a bubble and all bubbles pop and prices are going to come down. We just have to wait it out. What happens at the peak? Does it stay high, or what causes it to deflate?
Well, there is a cycle. And inflation could lead to deflation. Deflation could lead to inflation, depending on how the Federal Reserve reacts. So if the Federal Reserve reacts to inflation with aggressive rate hikes, then and contracts the money supply, which is what it should do, we will have a deflation. My concern is the Fed won't do that. And in fact, any sign of deflation is immediately met with inflation, because the government is so scared of deflation. Even if we get close to it, even if we just get lower inflation, not actual deflation, but if the inflation rate gets too low, the government panics because they're so worried that we might get deflation that they preemptively create even more inflation to try to prevent that from happening. But if we did have a big deflation, what would the government do? They'd print a bunch of money. They'd slash interest rates. So any deflation automatically leads to a surge in inflation. But whether inflation will eventually produce another round of deflation depends on what the Federal Reserve does. Again, I think at this point the stakes are too high, and they've already staked out their position. Really, they're staying at zero. They're not going anywhere. And if inflation gets worse, well, they're just going to pretend it's not a problem. They're going to pretend it's transitory. Then they'll pretend it's a good thing. But the only thing they won't do is fight it, because they can't. I mean, if the Fed could actually fight inflation, they'd be doing it right now. It's already bad enough that they should be doing something. The reason that they're not is because they can't, but they can't admit that. So they're pretending they will if inflation ever became a problem, even though it's already a huge problem right now.
Wow. It's a lot to understand. So we have thousands of people all over the world listening, a lot of them, of course, here in the US, but most are in the residential real estate business. What should they be doing to position themselves for what you feel is coming next with this discussion? What should the real estate investor, the real estate practitioner, what do you feel is a good thing for them to be doing right now?
Well, I think you should have property that has a good cash flow, have good tenants. I think you should try to have debt on the portfolio, especially if you can lock it in at a low rate for a long period of time, because I think you may end up making more money as a debtor than as a real estate owner. Mm-hmm. But also understand, where your property is and what the dynamics are, because there are going to be properties that suffer, and there's going to be properties that do well in the economic environment that I see coming. If you have rental property, obviously the real value of the property is a function of what the rental market is like. And if you're in an economy where you have very high inflation, it's going to be hard to pass on the rents, because mm-hmm. people need to pay money for food, they need to pay money for a lot of other things. There may not be much left over for rent. And of course, what you have to realize is that demand for housing could, or rather supply can increase rather rapidly in depressed situations, because everybody who owns a home can potentially start renting out rooms, right? So I need extra money. I can't afford to pay, my food or my electricity. I'm going to rent out one of my bedrooms. Now, all of a sudden, there's more supply coming out of the single family housing. Also, a lot of people that live by themselves, I'm going to get a roommate. And so people are doubling up. You might find more families doubling up, sharing the same residence. So all of a sudden, you've got a lot of supply, because people's standard of living is falling, and they're trying to accommodate by reducing their costs. And so that could make certain types of real estate in certain areas more vulnerable, because if the property is just sitting empty and you're not getting any cash flow, meanwhile, inflation is increasing the cost of maintaining the properties, governments are increasing taxes on the properties, there could be a lot of problems. On the other hand, I think there's a lot of parts of the world where you're going to see strengthening currencies, rising real incomes, where real estate prices are doing really well. Because when you look at currency as kind of like a zero-sum game or a seesaw, as the dollar loses value, other currencies gain the purchasing power that the dollar loses. So Americans become poorer, other people become richer. And as those people become richer, they can afford to pay higher rents. They can afford more housing. And so it's going to be a mixed picture depending on where you own this property. what's going to happen to it. And certainly even in America, there'll be certain areas that can do well in this environment where others won't. So, you just got to be careful. And I think you got to look at prices and valuations. I think some of these markets where prices are very, very high, and clearly you're talking about bubble territory, there is a lot of risk. But if you're looking at buying in areas where, you could buy real estate where it's arguably cheaper to buy than build. I mean, there are plenty of places that you could buy property where it's less than it would cost you to build something comparable. In some cases, it's like you get the land for free because the construction costs right now are so high, and they're going to get higher. And it's not only the material costs that are high, it's the labor costs. So as it costs more and more to build new homes, the homes that are already here are that much more valuable because they don't have the competition from the new homes that are being built, because they're not being built because it's too expensive, or they can't even do it because the materials and the labor are not even available.
So how long do you think this current inflationary cycle is going to last? How would we know? How do you know? What do you look for in terms of it maturing or moderating? What is your expectation for this cycle?
I think it's going to be a long time. I don't know, when there will be the political wherewithal to do something about it. I mean, I think it's going to have to get really horrific. But I do think that they're going to try a lot of crazy things first, like price controls. We did that in the 1970s. It didn't work. And in fact, the inflation is already worse now than it was back then when we tried it. But I think we're going to try it again.
Can you tell me what that is? Peter, can you tell me what price controls are?
Well, that's when the government makes it illegal to raise prices, right? They basically fix prices. They say they go after the symptom and not the disease, right? Because if they keep printing money, they keep creating inflation. And if they try to limit price increases, it's not going to stop it. Because what happens then is that you have shortages, right? So yes, the price doesn't go up, but what good does that do you if you can't buy the good? The good isn't there. And the way you ration the goods, because in a free market, we ration goods on price. So if there's a short supply, a lot of demand, price goes up. And then some people won't buy it because it becomes too expensive, right? And so there's always a balance between supply and demand. But if the government stops the price from going up, right, and they keep printing money, demand skyrockets, but supply doesn't go up, you have a huge shortage. And so how do you decide who gets the product? Well, you have a long line, right? You wait online, for hours and hours in order to get the product. So if you're not willing to wait online, you're not going to get it. Now, some wealthier people will pay people to wait online for them to get the products. But there are other ways of, distributing the goods other than rationing them through price. But what ends up happening, though, when you have price controls, apart from companies finding ways to get around it, like they'll come up with a brand new product that is different from the other products, so it's not technically subject to the price control. But you end up with black markets, right? You end up with goods being available illegally, by criminals who will sell them at a higher price that's against the law. But if you want to buy this stuff, that's how you buy it, right? You buy it illegally on the black market. And so that's what price controls produce is black markets. But, shortages, rationing. I mean, one thing with power, right? If the government puts a control on power, we're going to have rolling blackouts. We're going to have to share the power, and everybody's going to have to take turns, having no power, as opposed to letting the price go up and letting people adjust their behavior accordingly, where people just stop using power who can't, pay the price, or people will be more economic. I mean, that's why you remember the long lines for gas in the 1970s. That's because they were controlling the prices. If they just let the prices go up, there wouldn't have been long lines, right? Just like, in the US, every time there's a natural disaster, the government wants to go after somebody for price gouging if they charge too much. But that's a mistake, because you actually want the price gouging because it's the best way to ration the goods and also eliminate the supply shortage. Because if the price goes way up, then supply will come in from other areas of the country to meet that price, and ultimately the price will come back down. But when you stop the market from sending these signals, then the shortage gets worse, and the ultimate upward pressure on prices gets worse.
Julie and I listened to your podcast. The other thing you're talking about a lot, you listeners, you guys should be listening to, it's called the Peter Schiff Show, obviously on iTunes and everywhere else. Well, can you explain to the listeners what stagflation is? That's something I've only heard, Julie and I've only heard you talking about.
Well, other people talk about it only to basically dismiss it. But what happened was during the 1970s, we had a condition where the economy was weak, but inflation was strong. And that combination was a paradox to Keynesian economists, right? That is the school of economics that pretty much everybody ascribes to these days. But under Keynesian economics, inflation is a result of a strong economy and low unemployment, that when resources are fully utilized and everybody has a job, that's when you get inflation. And of course, that's completely wrong. In fact, it's backwards. And the Keynesians believed that it was only when you had unemployment and a weak economy, well, that you wouldn't have inflation. So they thought there was a trade-off. They talk about this thing called the Phillips curve, which equates employment with inflation. And so during the 1970s, something happened that the Keynesians thought was impossible: the combination of high unemployment and high inflation. So they had to come up with a brand new word for it because they didn't even think it could happen. And so that's where they coined the term stagflation. And we're experiencing that again, and it's going to be a lot worse. I've been calling it an inflationary depression because I think it's not just stagnation. I think we're going to have real contraction, and the inflation is going to be much higher than it was back then. So I think to say it's stagflation won't do it justice as far as the severity. I think inflationary depression is going to be a more apt description of what we're going to be living with.
So you are a firm believer in gold, right? Because gold's been money, real money for 2,000 years. I was thinking about asking you a crypto question just to get you going, but we might not. But as far as how would gold eventually explain I understand holding gold, it's an inflation hedge. People are arguing that crypto is an inflation hedge too. We could talk about that if you want to. Julie and I own gold. We don't own any crypto. So what does it mean for fiat currency if gold were to start becoming more desirable as a form of money? How would there be a transition, or would people? What does
that look like?
Yeah, what does that look like? Would there be a point
where
yeah,
you asked earlier about the normal inflation rate, and the normal inflation rate historically with gold is around 1 to 2% a year, meaning the supply of gold grows by about 1 to 2%. And that's about the same rate of growth of the population. So if the population is growing by 1 to 2% and the supply of gold that population can own is growing by 1 to 2%, it's a pretty stable relationship. On the other hand, the supply of money can grow rapidly. Like right now, it's growing, I don't know, 20, 30%. I mean, they're printing it like it's going out of style. So as people want to get rid of currency with a high inflation rate or money with a high inflation rate, and they want to go into money with a low inflation rate, that's gold, right? Because gold has a very low historic rate of inflation. And so more and more people will choose to own gold as a store of value, as an inflation hedge. Now, as far as crypto, I think the inflation rate in cryptocurrencies is much greater than the inflation rate in fiat currencies. If you look at the rate with which new cryptos are being created, there's about 13,000 of them now. New ones come out every day. And of course, each new crypto, the supply keeps growing. And then it's not just cryptocurrencies, it's non-financial tokens, the NFTs. I mean, there's all sorts of crypto things out there, and the supply grows every day. It's just that the demand has been there because it's a speculative mania. But at the end of the day, even Bitcoin doesn't have any of the properties that makes gold a viable money, because Bitcoin isn't a commodity. It doesn't have any historic value in relationship to any other commodity. I mean, gold being an actual commodity that is used in jewelry, we're wearing our identical gold watches again today. I wore it because
we did. Gold.
So,
Peter Schiff.
So you can't make these things out of Bitcoin, and you can't make, look, these watches wouldn't be nearly as nice if they were made out of tin or nickel or copper, right? I mean, they're made out of gold, and we pay extra because they're made out of gold for a reason. But gold is used in computers. I mean, we're having this conversation. These computers have chips in them. Those chips have gold, right? Because gold is a great conductor of electricity. So there are all sorts of uses in medicine and aerospace for gold, just like there are actual uses for all the other commodities. And so over the centuries, there are historic relationships between the price of gold and the price of copper, between the price of gold and the price of wheat or soybeans, or oil or any other commodity that's used for something. There's a relationship there. Bitcoin has never been used for anything and will never be used for anything because it has no actual use value. You can trade Bitcoin, right? If somebody wants to buy it from you, you can sell them yours. But absent that, there's absolutely nothing you can do with it. There's nothing that anybody can do with it. There's no real user for Bitcoin the way there are lots of real users for gold. And when I'm storing my gold, what I'm storing is its future use as a metal. And what makes gold so valuable as a store of value is that unlike other commodities, gold doesn't depreciate, it doesn't deteriorate, it doesn't tarnish, it doesn't rust, it doesn't decay. My gold will be exactly the same in 1,000 years. And in fact, if you melted down this watch, you can extract all the gold and use it all over again. It's exactly the way it was before it was put into the watch, right? I mean, what other commodities can you use over and over and over again, and they don't lose any of their value? I mean, most commodities, you use them and they're gone. I mean, I buy wheat, I make bread out of it, it's gone, right? I mean, I can't reuse it over and over and over again. So gold, the price of gold is basically the present value of all of the uses for that gold for the rest of eternity, which is one of the reasons that the price is so high, because it reflects that. And of course, gold is very scarce, so there's not a lot of it, so that's there. But even if you accept the fact that Bitcoin is scarce, scarcity in and of itself means nothing. I mean, what good is a scarce thing if it has no use? But I wouldn't even argue that Bitcoin is scarce, because I don't think any of the other cryptocurrencies are really that much different from Bitcoin. They have a different name, but the difference is not as great as the difference between gold and some other metal, or between gold and another commodity, right? There you have a great difference in physical properties, very little difference between Bitcoin and any of these other coins. One of the reasons I laugh about, when the Bitcoin guys want to make fun of Dogecoin, and they'll say, Dogecoin is a joke. The joke is, so is Bitcoin. That's why Dogecoin was created, because it's exactly like Bitcoin, to show how ridiculous Bitcoin is. So the Bitcoiners just don't get the joke, because anything they say about Dogecoin can be said about Bitcoin too. It's the identical criticism. So if you're living in a digital glass house, you shouldn't be throwing stones.
Well, so we, the three of us, are surrounded everywhere we go with crypto people. I think for every, right?
Every day it's more and more.
Dorado has got to be the epicenter for crypto people on planet Earth. Has to be. I've heard rumors that Soshi, I guess, who started Bitcoin.
Oh, you mean Satoshi Nakamoto? That guy? Yeah, that gal? Guy. No one knows, who this person is.
Are you sure it's not you? I heard it's you.
I wish it were me.
Yeah, right. Well, I just, and every time we sit down, we talk with them, and I'm trying to understand. Now, I know some of these have interesting technology that's behind them. Bitcoin is Bitcoin, but some of these others have interesting blockchain technologies and things that you're indirectly investing in. That's kind of cool. But considering there's you said 1,200, I thought there was like
12,000, almost 13,000 now or something.
I mean, I don't understand how, in what world would a cryptocurrency replace the US dollar, let alone become a global replacement for even gold as money? Have you ever
We
heard
keep
it?
looking for that missing link
Yeah,
where we have that
we're
light
trying to
bulb go off and go,
Yeah.
We're
that's
trying to
what it is.
understand it. No one has actually explained
Not
that to
yet.
us. Can you explain?
It's not going to happen. It's all part of the fantasy of the bubble. I mean, it's really a cult. What's going on, and people just believe in this get rich quick fantasy that they have. But the reason I think that we see a lot of people here in our community is some people that did get in early, right, made a lot of money, and some of those people, those early adopters who made a lot of money, have moved here. Right? And having a lot of money is one of the reasons that you would want to move here. And of course, now you have to have a lot of money to afford to be here. So we're getting a distorted view of Bitcoin, because I think a lot of the people who are into Bitcoin, the vast majority of them, got in over the last few years. So some of them are ahead, some of them are behind, but the ones that are ahead, I mean, if you bought Bitcoin at 30,000, 40,000, and now it's at 60,000, I mean, yeah, you've got a gain, but it's not the kind of spectacular gain that the people who bought Bitcoin at $1, $100 or $1,000, they're sitting on huge gains, but there's not that many people like that. The vast majority of the people got in with all the hype, with all the sensationalism of the last several years. And those are going to be the bag holders, right? They're going to be getting in at the top of the Ponzi or the pyramid. But I do think a lot of the people who got in earlier, who didn't know to leave the party, who stayed at the party too long, they're going to end up giving back most, if not all, of their gains. And in fact, they may end up losing money, especially if they bought more along the way, right? Some people might have bought some Bitcoin at $1, and maybe they only put in a little bit of money. But then when it got to 5,000 or 10,000, they got really excited and they put in more, right? And now they're still ahead. But if we crash back down to 1,000 or 500, even though they may have some Bitcoin at $1 or $10, their average cost may be quite a bit higher now, especially if they put in more money at the higher prices. Because I think in the early days, people were like nervous about putting a lot of money in it, so they just put a little bit in to see what would happen. But then once it went way up, they became more confident. They had the courage to invest larger amounts, or maybe the stupidity to do it. But so when it comes down, they will have averaged up. I think the smart money, and there is some smart money in Bitcoin, obviously. The smart money is selling and has been selling for a while.
Yeah, we've been having conversations with some of these Bitcoin folks, crypto folks, and they are selling and they're buying real estate, and a lot of them are buying real estate here, as you know.
Yeah,
but it's fascinating. They are trying to, but we have to be nice to the crypto people, especially here in Dorado. They do throw the best parties. You can't argue with that.
Well, that's always the case. I remember I went to this conference in 2005, the Western Regional Mortgage Bankers annual conference in Las Vegas. I went there twice. You can see my presentation from 2006 on YouTube if you just Google Peter Schiff Mortgage Bankers. And I went there basically looking for people to invest in my hedge fund to short the subprime market. But the year before I spoke, and that was at the height of the frenzy in 2005. And you wouldn't believe, I mean, they had tigers in cages. I mean, this thing, I remember one of the sponsors of the event was a company called Subprime. I even have to find their pen because, it was like, ex-con will finance you. I mean, anybody can get a mortgage because these were for the people that their credit was so bad that they weren't even considered subprime. It was like, you were even worse than that, but don't worry, we'll finance you. But yeah, I mean, whenever you have the most amount of easy money, you have the best parties because easy come, easy go, right? I mean, you got all kinds of money, you can spend it on parties. So it's great that they can throw the parties, and I'm happy to go to the parties, but eventually the party is going to end for the crypto people.
One last question. I really appreciate it. We've really enjoyed this, Peter.
Yes, thank you.
You're very, very generous with your time and knowledge. And I love how you can take something that's complicated and you can explain it in such a simplistic way. And you're not trying to be condescending with how you're trying to explain things, which is unique for an economist like you. The last question would be, so a year from now, and we're talking again on October 27th, 2022, what would be the two or three things that happened in that previous year that people will be most surprised about, in your opinion?
Well, I don't know. I mean, it's a year is, in the scheme of things, is a pretty short time horizon. A lot of things could happen that would surprise people. I mean, the crypto bubble could pop, could crash, 80, 90% or more. That would surprise a lot of people in crypto. Inflation could really take off. I mean, that would surprise all the people who believe it's transitory. The price of gold could really spike. That would surprise a lot of people who think it's dead and think that it's no longer an inflation hedge. Maybe the bond market could collapse and interest rates could really go up long term, which would probably surprise a lot of people. There are a lot of events that could happen. Maybe the markets will crash. Maybe the stock market. I mean, because it's certainly in bubble territory. There's certainly all sorts of evidence of not just irrational exuberance, but irrational exuberance on steroids, which was the title of my podcast I just did. So crazy things are going on. But what I think people need to do is invest based on the fundamentals. Forget about all the noise. Recognize that you don't want to be in paper because the biggest losers are going to be the people holding the paper, other than the people holding the crypto, which isn't even as good as paper. But if you've got bonds or things like that, you're gonna suffer. So you want to own real things. And personally, what I'm involved with is I like to buy companies that pay good dividends. I mean, just like you buy real estate, you want rent. I buy companies that pay good dividends, companies that own a lot of real resources that I own as a shareholder, whether it's natural resources, mining, energy, agriculture, or plant and equipment that they have, goods that they produce based on this equipment, that there's real value there. Earnings that can be returned to me as a shareholder. I like companies that are not reliant on Americans as their customers because Americans are broke. I like companies that rely on productive consumers that actually have real jobs and produce things and have savings and don't rely on government. So there are certain companies. And that's why, for people, if your listeners, you're making some money in real estate, but you've got some other money that you want to keep liquid, you want to have a portfolio potentially to draw on to maybe buy real estate in the future if you see some bargains. That's what I'm doing, managing portfolios for people through my mutual funds and through separately managed accounts. If you're a U.S. citizen, you can buy my mutual funds anywhere. You can take a look at them at europacfunds.com. If you're outside the U.S., you can't buy my funds, but you can set up an account with me at the broker-dealer here, at the asset management company here in Puerto Rico, and we can directly manage a portfolio in foreign stocks, in gold stocks, in the type of investments that will do well in stagflation. And if you don't own any physical gold or silver, you can get some of that through Schiff Gold, and that's at schiffgold.com.
Excellent. Well,
Thank
we
you
really
for that.
sincerely appreciate it, Peter. It's fantastic. Finally having you on the show.
All right. Well, good luck, guys.
Thank you.
Yes.
Have a great day, everyone.
Thanks very much.